Bitcoin getting crushed again. It is now off 16% since hitting all-time highs earlier this month.
But the bank also pointed to tens of billions of pounds in extra savings by households who have not been able to spend, but at some point could be unleashed. Another much-needed shot in the arm.
Assalamu alaikum, and welcome to another episode of Focus on Finance. In today's episode, we look back at the financial crisis of 2008. Joining me in the studio to discuss this topic, Mr. Shafique Bhunnoo, who is an accountant by profession, the managing director of a management company here in Mauritius, and the chairman of Mauritius Finance. Assalamu alaikum.
Wa alaikum salam, Shafique Sahib. Thank you for having me on this program.
It's a pleasure. In previous episodes, we talked about banking, and we wanted to bring the discussion to a specific event which highlights some worrying aspects of the financial environment and system, specifically in banking and housing, etc. So this is 2008, the financial crisis. Take us back to what happened then.
I think the crisis of 2008 is just a symptom of what started well before, right? And we spoke about the system of interest and the Islamic system. I think that was a demonstration of the massive shortcoming of the interest-based system. The global financial crisis, or as we used to call it, the subprime crisis, was basically the failure of the system to recognize a risk in providing loans to people who didn't have the ability to repay. Because there was liquidity in the system, so the banks were sitting on an enormous amount of cash, they were under pressure of giving massive amount of loans. So they were giving out those loans in massive amounts to people who consciously didn't have the ability to repay. And they were not talking about prime type of mortgage, it was subprime mortgage, subprime type of properties. And then what they were doing, they were securitizing those properties. What securitizing means, in simple terms, is let's say you have a bunch of 100 houses that you're given loans. You take those loans and you transfer those loans, those properties, the loans that you're given on those properties, in a vehicle, and then you would break each, so the total loan amount will, let's say, be 100, and then you will issue shares of that company to different investors who would actually be investing into an underlying loan, right? Mm-hmm. We call it a security, or they can issue a note basically, where that would be tied up to the value of the loan. But the issue with the type of the loans that they were issuing is the denomination of the loan wasn't necessarily correct. So the risk profile with the loan wasn't being totally reflected. So let's say people were expecting, they were investing into a loan where the default risk, basically where the event of default or the risk of default would have been much lower, mm-hmm. But the actual risk is the people would have automatically defaulted because they had no payment, the ability to make the payment. So the bank basically gave a loan to someone who basically didn't have the ability to repay. Then they sold that loan to investors globally who basically trusted the bank as an arranger. And then we're talking about very large, prominent banks globally, whom they trusted as a counterparty. And basically those banks were just selling them literally rubbish.
So we've gone into quite a lot of detail there.
Yeah.
There's quite a bit to unpick in what you've said.
Yeah.
Let me bring you back to basics,
Yeah.
Just so we can follow this complex series of events. Let's start with maybe not everyone is aware of what we're talking about, the context.
Yeah.
So in 2008, we're talking about the housing market in the United States of America.
Exactly.
So I think that's specific. It's not a global phenomenon.
Yeah.
So this is specifically about banks lending money to people to buy houses in America, in the United States of America. And a home loan is also known as a mortgage.
Yeah.
So that's what we're talking about. Something happened. What was in high level, what defined the financial crisis of 2008? What happened?
Basically, when the banks realized that the value of the loans, the underlying, so the investors realized that the underlying value of the loans was basically was nil, had no value, all of a sudden everyone wanted to sell. And the moment there was a run basically to sell out the banks, the value of the securities, there was no buyers and everyone wanted to sell. It's a simple demand and supply type of thing, right? Excess supply, barely any demand. So the value just fell to zero. And all of a sudden, the value of the assets that most global investors were holding, which is very important to understand. So those loans, as they were securitized, were being sold to US and international investors massively. So people who had put their money there basically lost absolutely everything.
So I think it's good to explain in simple terms what we're saying here. In 2008, before the financial crisis, there was a market that had value, that people were putting money into investments, and they're putting money into the stock market and into the financial system. The financial market crashed in 2008, where I don't have the figures, but there were trillions of dollars worth of value was wiped out.
Yeah.
That is what defines the crisis.
Exactly.
So the market was growing year on year. Prior to 2008, everyone was congratulating everyone else that we're getting richer, we're making more and more money. Those with money were making money. Something happened and the money disappeared.
Exactly.
So that is what we call a crash.
Yeah.
So it went up, the value dropped. And what is interesting is you say what caused the crash, which is the detail you've gone into, is something to do with the housing market.
Exactly.
The loans that banks were giving. So first of all, before we come to securitization, let's talk about what caused the housing market to increase and what was behind it. I think. But we can't divorce it from securitization. Yeah. So let's first explain the first bit. Where does securitization come in? How does it distort the lending for house prices for houses in America?
I think in terms of the lending itself, any prudent lending will ensure that your repayment capacity should not exceed 40%. So of your total income. So whatever you have to repay in terms of loan should not exceed 40% of your income. So that would be typically banking norms in terms of how you give loans. In those cases, those norms were not respected. So loans were being given to people who had no capacity to repay. And in that process, there was one very famous investor, John Paulson, who said that he had discovered something fundamentally wrong with the housing market in the US. When his mate working for him was getting a loan to buy her third house. So that said along, that gave him the indication that this market was dysfunctional. There was going to be a massive problem, and there was going to be a crash into that market. So obviously he did some financial transaction to basically make a profit out of the crash, which is also possible via shorting. He did that. He made massive money out of it. But clearly, a lot of people lost their life savings, lost everything out of that process. So what happens is, let's say once they know that the value is going to fall. But people, so long they are selling and they are still getting market to sell, the value stays constant. And unless someone actually goes and reclaims the house, where the value should sit, there is no way to be able to prove the value of the house, except by the valuation that has been given for the loan. So someone values a house of X, they take a security on the house, and then they just sell the house and give a loan on it. But let's say tomorrow the person has no ability to sell the house, has no ability to pay the loan. The bank should take repossession of the house, technically speaking. But let's say now it's not about one house or two houses, it's hundreds of thousands of houses. And basically those people have the ability to actually repay their loans. So all of those houses come back onto the bank's books. But banks is not in the business of holding houses. So what do they do with those houses? So all of a sudden you have an excess supply of houses, and the value of the houses just crush massively because there's no buyer for the houses. So that in effect demonstrates how the value basically goes down. Mm-hmm. That was the concept of the value going down. Now securitization, what the banks were doing basically, instead of holding them on their books, once they get a pool of 100 houses, they say, okay, let me create a financial product. Let me get it off my books. So what I do, let's say the value of the houses, the value of the loans is worth, let's say, 100,000 rupees, right? I create a product, I move this bunch of houses, the ownership, the guarantee of those houses that is sitting in my books onto another legal entity outside of my books, right? So I put the guarantees there, so the right and obligation of the loans will then sit with that special purpose vehicle, that legal entity, that company there, and then what they do, the repayment of the loan comes to the bank. The risk associated with that loan sits in that SPV. So effectively what they do, they will go and sell out that SPV into multiple smaller parts, because they can't just sell 100,000 to one party. No one will take that risk. So what they do, they create 100 parts of it, and then they sell 100 parts of 1,000 rupees. Then they can get sellers. So what happens is they create multiple blocks of small SPVs with hundreds of houses in there, and then they sell it to different investors. Those investors say, okay, I'm diversifying my risk because I'm taking exposure to SPV1, SPV2, SPV3. But in effect, they are just taking the underlying asset is basically a bunch of houses that have been that actually will have no value in some time. But they don't know that, because for the time being, they're buying from, let's say, a very large US bank, a large European bank who's massive in that market. They're just selling. Everyone is making money. So what happens is the bank is selling the risk of the assets to someone else who is buying it. The bank is getting his own money. And then basically on the back of it is going to take more exposure and going and on. That was just a cycle of selling houses at basically they are not doing their work in terms of ensuring the repayment capacity of the people, because the liquidity is there in the market. They're just giving people money, and then someone else is taking the risk. Mm-hmm. So if you look at the system, the house owner, the guarantee of the loan of the house owner is maybe owned by someone sitting in Asia, sitting in Europe, sitting in Australia, without even knowing that person. And unfortunately, what happens is they are so remote from the market, they don't understand what's happening in the market. It's only where things just hit the fan, then they start to realize, oh, there's a problem, and the first reaction is, let me get out of it. So this is what we talk about a self-fulfilling prophecy. The moment you start selling, putting back those houses, basically getting out of those zones, you basically are saying, I'm not going to take that risk anymore. Mm-hmm.
Yeah, so let's go back. I think let's unpick that slightly. So initially, when a responsible bank is giving a loan to buy a house and he gets all the repayments for that loan, he will check whether the person can repay that loan. So they look at what job you're getting, how much money is coming in, the value of the house, because ultimately a normal responsible bank will want the repayments.
Yeah.
And then the house is a security. If things go wrong, it can take possession of the house and sell it. Exactly. This is a normal housing loan. But what was happening prior to 2008, they were not keeping the loans. So they were actually selling on the loan. Yeah. So they were selling the loans. People were taking a loan out with a bank, but the bank was actually selling this onto other investors.
Exactly.
This is a securitization. Yeah. They were putting it together. Once they've sold it, if they stop paying, the bank has no risk.
Exactly.
Because now it is the problem of the person who's bought it. And the magic that sort of happened was that the securitizers were saying, we have got 100,000, let's say 100 different loans. Not all of them are going to default. You're only going to get 5 or 10%.
Exactly.
So if we sell this as a group, most of the time, you're guaranteed you're going to get your money back.
Exactly.
Yeah. And then, but then eventually they got to the stage where, because the bank was selling on the loans, it just needed to give loans out.
Exactly. So they just needed to continue to build a pipeline of loans that they had to give, because they had no risk. So for them, it made no sense not to stop giving loans. So they were just giving loans, building a pack of houses, selling it to someone else. So the risk was transferring to someone else. They were making money.
And if people have seen in the commentaries the subprime crisis.
Yeah.
So a prime loan would be someone who's well off, secure job, can afford a house.
Yeah.
A subprime mortgage will be what?
Basically, people who are really at the very entry level of being able to own a house. So that will be their first property. They will be struggling to pay their loans, but they will need they will be to be accompanied through the process, ensure that they can eventually, over 20, 25 years, actually get the ownership of the house. So it's not something that's very straightforward. And it's very risky, because those people typically are not into formal jobs, they're into informal jobs. They will be working 3 or 4 jobs to be able to meet the ends and ensure that they can pay their loans. So it's an extremely risky market and an extremely potent market, because those people, they're probably immigrants or children of immigrants trying to have their first house ownership in the country, in the States.
So, I mean, it's interesting when you look back at it. They were not only selling up to 100% mortgage, so that you could borrow up to 100% of the house price. They were giving loans 110%, 120%.
Exactly.
So you could take the money and buy furniture.
Yeah.
And there was even what they were calling ninja loans. No income, no assets. So someone has no income, no assets, but is willing to sign a loan agreement to buy a house. And that worked because the assumption was house prices will always go up.
Yeah.
But once house prices stopped going up, these people could not afford, could not sell, and the downward spiral. But how does that relate to Islamic system and interest rates? And
I think when banks give loans, right, their only concern is how to get their money out and get the interest. In the Islamic context, the risk associated with a loan sits with the bank. And basically, it's a shared risk with the person receiving the funding and the bank coming into play. And there's no interest. So if there's no profit, there's no interest. So how does actually a home loan happen? Very often it happens in what we call a sort of a cooperative way. So everyone tags along and then helps someone to get a loan, get a house. Then basically the group will sit down together and then help the next person. For a cooperative basis, you get a house. Secondly, Islamic banking, basically, they typically fund things that generate revenue and generate profits. They don't actually fund typical just mortgage or typical hire purchase or whatever. So it's something that creates a profitable activity, and then there can be participation into the process. So just think about the house owner. If the person didn't have the ability to own the house, he would have to come together with other people who didn't have the ability to own the house. Together they would pool on their funds, and then they will try to get a house within their means. And then they will, once they've given one person, then it's going to the next person, and then in rounds over years, everyone would have owned their property, and they would have owned it without interest, and they would have got it in full ownership. And I think that's very important. The way that the cooperative works in Islam and the way that the banks work is totally different. Here, it's a group of people, it's contained within that group, and everyone works together to ensure that they get in place. Whereas in the I would say in the typical subprime crisis, no one actually cared. They just sold houses. You need money, I'll give you money because someone else is going to pay eventually. So the person giving the loan, the bank giving the loan, had no risk eventually, because they know that they would sell that loan to someone else first. Secondly, it was the people buying the loans were trusting the banks that have done their work, because they were reputable banks, AAA rated banks. That is the highest rating that you could get for a financial institution in a very regulated country like the States. So the entire system failed there. And that created a massive crisis, because you can think about it. The exposure was trillions of dollars. Multiple trillions of dollars that just got wiped off the system overnight. I still remember in September 2008, I was working for a financial institution at that point in time, and we were on a business trip in India. And we were sitting in that lobby in the hotel, and we were looking at our phones and just seeing this unwinding before us. Lehman Brothers crashing, people just leaving their offices, like nothing happening. So that was literally scary, but that was just the start of the event. The way things unfolded over the next few years demonstrated how I would say not messy, but unregulated or unethical the banking industry was at that point in time. And there needed to be a massive change in the I would say in the ethics of doing business, and probably more compliance with regulations than there was before, to ensure that these things don't happen again.
Yeah, but it's interesting in the Islamic context. I think, from my perspective, it just showed you the inherent. It exposed the underlying reality. In fact, it's not because they didn't follow regulations. For me, it's more. This is showing, giving a foretaste, a preview of what will happen when the system collapses, or potential. It might be even more violent than this, because ultimately there is no value there. People were believing, and if you remember back, I also lived through it. The correction came, and they were very open about it. This is what is interesting. The central bankers in the US and Europe, they didn't say we're going to give people money or increase the strength of the economy. No, they have to put money into banks, not to capitalize them, but to restore confidence. They were clear. They said we have to restore confidence in the system so people start believing their money is safe. But if they don't believe, it's not safe. Whereas if it's something the Islamic system says, invest in things that are real. Whether I believe or not this is a phone, it's a phone. They are telling you, believe I have a phone. And if you don't believe, it'll be one. But if you believe, that's fine. Everyone's happy. So this is, I think, is something that people, students of economics, can go back and study. Those in the financial industry have to take lessons from. But I feel that perhaps we're losing somewhat the lessons that should have been learned. Because I think, I don't know if you share my analysis. After time, people keep making the same mistakes again. We're seeing it with cryptocurrencies, different other, new ways of working, even the dot-com bubble and so on. These are people believing in things that don't have value. Now the metaverse is coming. So Islam teaches you some very simple things. Write everything down, don't have interest, work hard, pay your chanda, pay your zakat.
And also pay people before their sweat is dry.
Yes.
I think treating people well. And the very basic of the principle of Islam is that there must be substance behind whatever you do.
Absolutely.
And I think what's lacking in most of the transactions that we're seeing today, let's take crypto, right? What backs crypto? What's the intrinsic value of crypto? It's nothing. It's only the usage of crypto that creates its value. Whereas it's just a currency that's unregulated. And it's not backed by any central bank. So in itself, it's something like acting as an alternative to central banks. How does that work? How actually does it build its value, except from people giving its own value? having a perception of value. It's pure, basically, speculation. That's it. It's just like you playing on the stock market. Let's say tomorrow we're talking about one of the largest companies, Tesla. Someone believes that Tesla will not be able to deliver on its promise. Actually, the promise of having a sustainable battery is false. All of a sudden, the price will just drop down. And all of a sudden, Elon Musk is just the richest person in the world.
Yes.
It's crazy how perception changes things. And I think perception of reality and reality are two different things. You cannot change reality. We can always change perception of reality. And that's why Islam is just based on reality. It's based on real assets. It's based on real transactions. It's based on real people. And this is what makes it even more interesting. Let's take a step back and think about the 2008 crisis. Had we gone into the cooperation model, this would have never happened. The banks would have never been able to profit from the innocence of people. You had people who basically lost their lifelong earnings. People, pensioners who basically lost all their money. So we cannot underestimate the impact of that crisis, which we are still feeling the effects until today. So it is something extremely important to keep in mind whenever we're making an investment, and think about the Islamic aspect of the reality of transactions. And once you've kept that in mind, that will make things much clearer in how you conduct your financial transactions as a Muslim.
Thank you. Once again, we could continue talking about this, but our time has ended for this episode of Focus on Finance. Interesting points. So there are some lessons in history, some things for students to go and learn a bit more about. But certainly the message I'm getting is the Islamic system makes sense, is logic, and it hopefully protects us from the issues that led to the 2008 financial crisis, which was started in America, but became a global phenomenon. So once again, thank you very much, Shahid Ulash. Very enlightening. I hope you can join us for future programs on different topics. And thank you again for your viewing and participation in Focus on Finance. Until next time. Assalamu alaikum.